If you wanted to invest $10 million today, what would you invest in and how would you do it? Asset management companies offer services and products that help with what and how. What are the investment options? You want to invest your money, your capital, in an asset that holds value, like a house. A security is the financial instrument that allows you to trade the asset, like the title deed to your house. When you buy or sell an asset, it is the security that changes hands. There's a long list of securities that you can invest in, but let's talk about the most common categories. Equity, commonly purchased through stocks, gives you part ownership in a company. If you buy Apple stock, you become a shareholder with two potential privileges. Number one, the ability to influence the company direction through your shareholder votes. And number two, the opportunity to benefit if the company performs well. This would come in the form of price appreciation, which means an increase in the share price, and dividend payments, the portion of the company earnings paid out to shareholders at the company's discretion. Of course, there are also significant risks, as the stock price will fall if the company performs poorly. Fixed income securities include any security with a fixed payment schedule, such as bonds. When you buy a bond, you effectively loan that money, called the principal, to the bond issuer, which is generally a corporation or a government entity. In most cases, you, the lender, will receive regular interest payments called coupon until the bond matures, when the issuer repays your principal. Investors generally hold bonds in their portfolio to ensure they have a steady income stream. Derivatives allow you to invest in an asset without actually buying or selling it. Let's say you expect the supply of oil to drop significantly, and you think oil prices will go up from $40 a barrel to $75 in the next few months. To benefit from this opportunity, you can buy 100 barrels of oil, but let's face it, who wants to have all those barrels in the backyard? Alternatively, you can buy a contract that gives you the right to buy 100 barrels at $40 a barrel in the next few months. If the price does go to $75 as you predicted, you could exercise your contract to buy oil at $40 a barrel and sell it at a market price of $75. You would make $35 per barrel minus the cost of the contract. This contract is a form of derivative called an option. Other forms of derivatives are swaps, futures, and forwards. An investor also has the option to invest in a fund rather than a specific security. A fund is a legal structure that allows asset managers to pool capital from investors and make investments at scale. Funds give investors the opportunity to diversify at a low cost with little effort. They are the core products of asset management firms and how they differentiate themselves. Mutual funds and exchange-traded funds invest in stocks or bonds. Each fund follows a certain investment strategy predefined by the market, the sector, and the securities they're investing in. For example, if you want to invest in the equity of large U.S. companies, instead of buying individual stocks of 500 companies and maintaining your portfolio over time, you can buy a share in a fund that gives you that portfolio. You can buy and sell mutual funds and ETFs the same way you do stocks. They're available to all investors and have a low minimum investment requirement. Mutual funds and ETFs can have a passive or active management strategy. You can think of passive management as an autopilot that automatically tracks a benchmark index, like the S&P 500, an index that shows the weighted average of the largest 500 public companies in the U.S. An actively managed fund, on the other hand, would try to outperform a benchmark index through various strategies. There are also alternative investment funds, such as hedge funds, private equity, and venture capital funds. These funds have more flexibility on the type of securities they can invest in as they are only open to accredited investors. They usually have a large minimum investment requirement and a lockup period where investors can't redeem their shares, which makes them illiquid compared to mutual funds and ETFs. Hedge funds also invest in securities like mutual funds, but they differ in their investment strategy. They're subject to less strict regulations, which gives them more freedom to take leverage and invest in riskier securities such as derivatives and illiquid assets. Private equity funds take pooled capital and do not usually buy stocks or bonds, but rather make investments directly in companies, often buying them outright. A typical private equity firm targets a mature company with the purpose of exerting influence to increase the value of the firm in the future, then exiting their investment in 5 to 7 years. Venture capital funds make investments in early-stage companies, like startups. They're usually comfortable with a high-risk investment that has a high potential for reward. How do you make the investments? As an investor, you have the option of investing your own money, DIY, or outsourcing the investment decision to a professional, outsource. DIY. Let's say you know where you would like to invest, but need a channel to access the securities. Some asset management firms provide brokerage services to help you execute your trades. If you wanted to buy 1,000 shares of AT&T in the 1920s, you would have waited in line at the stock exchange to make your purchase. In the 1980s, you would have called your stockbrokers to place a trade. But today, you can utilize the online brokerage platform of your asset manager and purchase AT&T shares within seconds. An investor can directly buy securities or mutual funds and ETFs through a brokerage. Alternative investment funds, however, are not sold through a brokerage and are only open to accredited investors. Outsource. You can also delegate the investment decisions to an asset management firm. They use expertise, tools, and market knowledge to build a portfolio that fits your specific needs. Traditional asset management firms offer separately managed accounts, or mandate accounts, where an individual or institutional investor's account is supervised by an investment manager based on the directions set by the client. There is also a service called Outsourced Chief Investment Officer, or OCIO, that allows small institutional clients to delegate even more strategic decisions to an asset manager. The OCIO sets the direction based on the investor's needs and allocates assets accordingly. While traditional asset management firms such as Vanguard, State Street, and Fidelity provide mutual funds, ETFs, and other add-on services, alternative asset managers specialize in a specific alternative investment fund type.